Thanks for clicking. Toronto's real estate market is going to crash by 30%, according to the economists polled by the Toronto Star in a new report looking at the housing market. The report comes amid the release of the UBS Global Real Estate Bubble Index, which places Toronto in the top spot of 25 cities, the riskiest housing bubble in the world.
It's nice to be appreciated.
The report goes over Toronto's housing crash in the 90s. When mortgage rates hit 13%, sales plummeted and prices didn't hit bottom until 1996. The report compares the 1990s crash with the current correction well underway, and then offers some predictions for Toronto's market going forward. So what I want to do today is go over the report, take a look at Toronto's previous market crash in the 1990s, discuss the run-up to the current market bubble, look at some troubling signs emerging from the Toronto real estate market, which UBS says is flashing warning signs, and then take a look at how far the Star's economists think prices could drop as this bubble burst plays out. As we'll see, with Canada's inflation rate coming in hot for the month of September, many are predicting a 75 basis point rate hike coming from the Bank of Canada at their rate announcement on Wednesday. We'll obviously have an update out on that announcement on this channel. Click like and subscribe to get those updates, but for now, let's get into this report. The Star's report begins by looking back to Toronto's housing crash that started in 1990. When by midway through the year, the Bank of Canada had raised rates 11 times, inflation was rampant around the globe, homeowners were on edge, and a recession was looming.
I see where this is going.
Indeed, in the preceding 3 years before the 1990 crash, Toronto's real estate market had nearly doubled, with an average price hitting $274,000. But then interest rates started rising and inflation soared, and by 1996, Toronto prices had fallen by 25%, with the average price hitting $198,000. And the Star says that the situation is very similar today, with rock-bottom interest rates inducing a real estate frenzy, leading to a 40% run-up in the price of Toronto real estate since 2020. With interest rates rising, the majority of the economists polled by the Star say that a 30% price correction is in the offing, with UBS saying that recent rate hikes by the Bank of Canada was the straw that broke the camel's back. Indeed, the Star points to the major impact that affordability is having on Toronto's real estate market, very similar to that of the 1990s. In 1990, the average Canadian home was priced 19% higher than what the typical household could afford. Fast forward to present day, and despite the recent price drops that we've seen over the past few months, prices are still 35% higher than what the median household can afford. So there is a long way to go before the Toronto housing market is affordable again. Tony Stillo, Director of Canada Economics at Oxford Economics, says that prices can only outpace income for so long, and that would-be buyers are sitting on the sidelines pushing down demand. And yeah, whether or not buyers are staying out of the market because they can't afford it, or because they won't afford it and they're waiting for prices to drop even further. As we've seen over the past few months, Toronto's real estate demand has plummeted.
Hot.
And we're also seeing a growing number of signs that Toronto real estate investors are in serious trouble, with more and more buyers backing out of assignment sales on pre-construction condos. An assignment sale is where an investor tries to sell his or her contract for a pre-construction condo at a higher price than listed on the contract. So if I bought a condo to be built by a developer in, say, July of 2020, prices have risen to such an extent that I could sell the contract for that condo and make myself a hefty profit. Or at least I could. As real estate prices continue to sour, investors are more and more backing out of these deals, which is going to put more downward pressure on prices. And this becomes a self-reinforcing loop. As prices drop, investors back out of deals, putting more downward pressure on prices. Investors back out of deals. You get the idea. So, rising interest rates, a long way to go before affordability is returned to the Toronto market, and a souring market for real estate investors. All of this, say the Star's economists, are going to lead to a 30% drop in prices in Toronto by spring. This would bring Toronto's prices back to December of 2020 levels. Philip Cross, former chief economist at Stats Canada, says that prices would have to drop 40 to 50% to return to 2015 levels, which would make the real estate market sustainable again.
Not on my watch.
So, in summary, the Star's economists say that the Toronto market is exhibiting remarkably similar characteristics to the real estate crash of the early 1990s. A massive run-up in house prices fueled by lower interest rates, followed by higher interest rates to combat the ensuing inflation, followed by a major price correction. But the real question is, how long will this play out? Will it take 6 years in the same way that it did during the real estate crash of the 1990s? If interest rates remain high or continue to get higher, then we could see this crash continue to play out well past the spring of 2023 that is being predicted in the STARS article. As we mentioned on this channel before, although most economists are predicting a 4.25% terminal rate, that is, the Bank of Canada will stop raising rates at 4.25%, there's very little reason to believe that's so. All of this is dependent on the inflation rate, and if that continues to come in hot, rates could very well go higher. One thing that is not mentioned in the STARS article is how high interest rates were that caused this major crash in the 1990s. They also don't mention that interest rates at that time were higher than the inflation rate, and as we've discussed so many times on this channel, that is not the case right now.